The Fed Chair giving his speech tomorrow at Jackson Hole. Here to discuss, Kristen Bitterly is head of North America Investments at Citi Global Wealth. And Brett Ryan is with us as well. He's senior U.S. economist at Deutsche Bank. Welcome to both of you. Brett, I don't feel like I'm ready to talk Jackson Hole yet. Like, we still have, we got to talk about NVIDIA and the there's so many other cross currents right now. And Chris, I don't know if you want to comment on that. I mean, how much oxygen is NVIDIA sucking out of the room right now, or delivering, I guess, to put it differently?
I think these were the two catalysts for this week, right? It was NVIDIA earnings, which I know you guys have tried to find different hyperbolic terms earlier this morning, but I think perfection is probably it, right? And so NVIDIA delivered, and then looking at Jackson Hole, I don't think we're going to get a lot out of Jackson Hole. I think what investors want to see are a couple of things. One, higher for longer. Is he going to mention anything related to higher for longer? I don't think he's going to touch the neutral rate. Right. I know we're trying to break that down and understand what that means for cuts going into next year. I don't think we're going to get much there. But since the conference is called Structural Shifts in the Global Economy, I think we may get something on housing. A little bit more. So what's going on in the housing market and trying to understand some of the dynamics that are not that intuitive there.
Do you think, Brett, that the rate hikes are, I mean, this is going to sound, look what they're doing to the housing market. In some ways, they're making it inflationary because there's no inventory and prices are doing what they're doing, even with mortgage rates. I don't know if that's what they wanted.
Yeah, well, with housing, I mean, that's where the immediate impact of monetary policy was felt. You saw rates go up, and immediately you saw the reaction in terms of mortgages, refinancing, all that transaction volumes all fell. They're all stabilizing, though, at the moment. I think with Powell's speech, what he's going to try to do, given the July 26th messaging of data dependence, there's not much he can say about the near-term path of the rate path. He's also, as Kristen mentioned, going to want to try to avoid R-star types of conversations that are quite sensitive to the market at the moment. However, what I think he could touch upon is inflation and reset the inflation views.
Do you think policy is restrictive right now? I mean, is there any? The people are literally debating whether it's restrictive enough, because of what the economy is doing. Is it?
The economy has certainly been resilient to 525 basis points of rate hikes thus far. That's undeniable. However, the lags of monetary policy, the headwinds that are facing the consumer coming up very shortly. Waning excess savings, student loans coming back, slowing labor markets, slowing income growth. Those are all about to hit. They haven't gone away.
Yeah.
So I would hesitate to say that there's need to do more. It's now the conversation shifting to how long, as Kristen said, do we stay here? Yeah. And I think the inflation story with Powell. Remember in 2021. He came up with the transitory speech that was, proved to be quite widely ridiculed. Yeah. Now it's a good time to kind of reset the chair's views on inflation. I think that makes sense.
Yeah, and Chris, I always like reading Richard Koo just because he's so unorthodox in many ways, and he's like looking for explanations. And when we've heard this, even in that New York, the Liberty Street thing about R-star, but is it because the way the global financial system works now that hikes just don't have the impact they once had? That you keep hearing this. Well, the credit markets are so strong, and there's the financialization globally, and that's why I don't know. Or are we all just trying to explain away something that in 6 or 12 months' time is going to look very different and more obvious of a slowdown? I
mean, I think the interesting thing is that every month it feels like we're in a different type of regime in terms of soft landing, hard landing, and so the conversation changes really quickly. I think right now, though, is Chair Powell's in a position where the tightening that we've seen, given the rise in longer-dated rates, whether that's attributed to his actions or not, I think it's really attributed to a couple of different things. It's the strong data, the resilient data from a U.S. growth standpoint. It's also because of the relaxing of yield curve control. And it's also because of the abundance of issuance that has come to market and will come to market. And so in that, I think he can take advantage of that and could still maintain a slightly hawkish message until we see this materially come through within some of the indicators.
Did we learn that the Fed in a rate hiking cycle doesn't necessarily kill tech stocks? I mean, NVIDIA, if you do something like that, you just power through multiple concerns. Doesn't matter if the multiple.
It's a great question, and it was something I've been thinking a lot about this year because I was in the camp earlier this year that it doesn't make sense, right, because of the rate sensitivity. I think what we've learned, though, is when you look at the free cash flow generation of these companies, it is more about the free cash flow generation and who's in a position that actually you're not interest rate sensitive because you can fund and fuel your own growth and innovation.
Your net income grows 400%. And your multiple goes from 20 to 19. If you're E is 400% higher, what difference does it make if it's 19 instead of 20?
Exactly. And a lot of people are hiding out within those positions.